Good day everyone. So this is all about the Philippine Budget System Report.
Good day, I am Jet Lantayona and this is my report. The term budget originated from the Middle English word bouquet that had derived from the Latin word bulga, which means bag or purse. Commonwealth Act, say in number 246, Budget Act defined budget as the financial program of the national government as for a designated fiscal year, consisting of the statement of estimated receipts and expenditure for the fiscal year for which it was intended to be effective based on the result of operation during the preceding fiscal years. And according to the Republic Act 992 Revised Budget Act, it says that describe the budget or the delineation of the services and products or benefits that would occur to the public together with the estimated unit cost of each type of service, product, or the benefits. And that's all.
I am Jimar Indawa, and this is my report. My report is all about the Philippine budget system. Philippine budget system is presently guided by two principal objectives that are vital to the development of progressive democratic government, namely, first is to carry on all government activities under a comprehensive fiscal plan developed, authorized, and executed in accordance with the Constitution, prevailing statutes, and the principles of sound public management. And second is Philippine budget system also is to provide for the periodic review and disclosure of the budgetary status of the government in such detail so that persons entrusted by law with responsibility as well as enlightened citizenry can determine the adequacy of the budget actions taken, authorized, or proposed, as well as through financial position of the government. So, ang kanak madugang san is about sang Philippine budget is 4 pieces comprise the Philippine budget process. Specifically, first is budget preparation, second is budget legislation, third is budget execution, fourth is accountability. Each piece is distinctly separate from the others, but they overlap in the implementation of the budget during the budget year. So, yung Philippine budget system kay mo ng palisiya during 1925 na ginatawag na budget policy.
Okay, this is all about the additional information about the Philippine budget system. So the budget process in the Philippines evolved from the early years of the American regime up to the passage of the Jones Law in 1916. So as early as under the 1935 Constitution, the budget policy and a budget procedure were established, and subsequently it strengthened through the enactment of laws and Executive Act Number 25 issued by the President Manuel L. Quezon on April 25, 1936. So the created the Budget Commission to serve as the agency that carried out of the President's responsibility preparing the budget. So then CARE Act Number 246, the first budget law, went into effect on January 1, 1938 and established the Philippine budget process. In 1973, the constitutions and various presidential decrees directed a series of budgetary reforms that culminated in the enactment of the Presidential Decree Number 1177 that President Marcos issued on July 30, 1977, and of Presidential Decree Number 1405 issued on June 11, 1978. That is all about the Philippine budget system process.
I am Christy Garcia Gumubao, and this is my report about bottom-up budgeting. Bottom-up budgeting is a form of financial budgeting where a company allows each department to set their own budget. Each department creates a list of expenses and cost projections, which is then submitted for review from senior management. Once agreed, these separate budgets are added together to form the company's overall budget. It is also referred to as participative budgeting because department managers are given a role in setting their own budgets. So, itong bottom-up budgeting is yung bawat department is gumagawa sila ng kanilang budget estimation, then pinapasa yan nila sa kanilang senior, which is pag once na-review na ng kanilang senior at aprobado na yung bawat individual budget is iniisa yan nila para ma-set yung overall budget. To create a bottom-up budget, the following is the basic process that organizations follow when formulating a bottom-up budget. The first step when creating a bottom-up budget is to identify the individual components of business and projects that the organization plans to carry out in the coming financial year. For example, a department may include costs like wages for employees, furniture and fittings, equipment purchases and hires, administrative costs, conference fees, etc. If the organization uses individual projects to get budget estimates, it must first obtain a list of all projects to be carried out in the coming year and then come up with cost estimates for each project. The second is get a sum of cost projections of each department. After departments finish preparing a list of planned projects and expenditure, the cost should be added up to get the total budget for the department. For example, the cost estimates of the Human Resource Department may include 10,000 pesos for recruiting personnel, 20,000 pesos for employee salaries, and 60,000 for administrative costs, bringing the department's total budget to 36,000 pesos. So, the department managers of other departments should come up with a total for their respective departments. Sum up the budgets of all departments. After getting the budgets of all the departments or identified projects, the budgets should be summed up to get the overall budget for the organization. The totals should be obtained from the departmental heads or head of projects appointed by the organization's management. The last one is submit for approval. So, the final stage of the bottom-up budgeting process is submitting the budget estimates to the management for approval. So, pag-review ng budget, if the management is interested, knowing na yung budget is aligned sa goals and objectives na yung kumpanya is gusto ma-achieve in the next financial period. If satisfied with the budget, the management will approve the budget estimates and send it to the finance department to make allocations to individual departments. However, if the company's leadership is not satisfied with the budget estimates, they can ask the department managers to make necessary changes before the budget is again submitted for approval. That's all, and thank you.
I am Zaria May Gonzalez, and this is the continuation of our report. So, deficit financing. Deficit financing means the direct addition to gross national expenditures through budget deficits, whether the budget deficits are on revenue or on capital account. This policy implies that a government is spending in excess of the revenue it receives in the form of taxes, surplus from public enterprise, loans, borrowing from central bank of the country, which also leads to the creation of money. So, ang deficit financing is said to have been practiced whenever government expenditure exceed the government received gikan sa taxes, fee o guban pa. It also adopts any one of all or all. So the government may cover the deficit either by running down its accumulated balances or by borrowing from the banking system. It also includes borrowing from central bank and withdrawal of cash balances, and includes markets borrowing. So according to McGraw-Hill, the Dictionary of Modern Economics, deficit financing is practiced by a government of spending more than what receives in revenue. So McGraw-Hill said that thus a government to be practicing deficit financing when it spends in excess of its current revenue. Deficit financing is mainly resorted to attain the following objectives. So the first is deficit financing is ginagamit as a simple and very effective fiscal device para ma-meet nila ang ilahang financial requirements sa government during emergencies such as parehas anang war. So according to Keynes, si Keynes ang popularize sa deficit financing as an effective fiscal instrument para makontrol ang economic fluctuations and para mutaas pod ang level of the employment and output. Number 3, sa developing countries, deficit financing is considered as a method to mobilize resources for planned economic development. Number 4, another objective of deficit financing is para itaas ang level of effective demand and thereby para ma-stimulate ang private spending in a depression economy. 5th, according to GM Keynes advocated deficit financing as isa ka instrument para to mobilize surplus labor and other idle and unutilized resources during depression for achieving economic development. In developing countries, the main objective of deficit financing is to remove the vital issue such as unemployment, poverty, and income inequality. So, the effect of deficit financing is a dangerous weapon to be handled carefully. Definitely, deficit financing is capable of promoting economic development in developing economies. It is used without any safeguard. It may generate evil consequence in the economy. Therefore, deficit financing produces diverse effect depende kung giunsa ni siya pagplano. So the effects of deficit financing can be studied under the following heads. So effect of price level. So in the effect of price level, there is an increase in the government expenditures. Deficit financing generates additional purchasing power. So dapat po siya, it should take necessary steps para ma-ensure ang reasonable rises in price. So effect on employment. So ang effect of employment is this is an instrument para to increase effective demand and ma-remove ang unemployment during dispersion. So, effect on distribution of income. So, the business classes will be benefited out of rise in price and increased profit earnings. So, on the contrary, ang mga wage earners, katong mga fixed income groups, suffer on account reduction in purchasing power. So, magresulta na siya from sharp rise in price and decreased money value. So, that's all. Thank you.
Everyone, I am Christiana Doro Estrella, and I will discuss to you all about the public borrowing or the public debt. So, public debt refers to the obligation of government, particularly those evidenced by securities, to pay certain sums to the holders at some future date. So, although most of the resources required for public spending are raised each year through taxation, it is rare for any modern budget to balance any one year. So, for a variety of reasons, ranging from a desire to accelerate capital spending to a policy of economic stabilization, governments may choose to raise some of the resources by borrowing rather than taxation. So, there are types of public debt. There is a internal and external debt. So, the public loans is floated within the country are called internal debt. And then public borrowing from other countries are referred to as external debt. So the internal debt is that the part of the total debt that is owed to lenders within the country. It is in the money that the government borrows from its own citizens. So the government borrows by the issuing the government bonds and treasury bills. It also includes the market borrowings by the government. So for example, in external debt, if a nation faces severe famine or and cannot secure emergency food through its own resources, it might use external debt to procure food from the nation, providing the entire loan. Then, and the second one is the productive and unproductive debt. So, when the government borrows for development expenditure, like on power projects, establishing heavy industries, so that it generates revenue, then the debt is productive. So, when the government borrows for non-development uses such as was finance and others, the debt becomes unproductive as it does not create any income in return. So, a debt is called productive if the loan is financed for projects which bring revenue to the government. So, for example, irrigation and power projects. So, productive debts are self-liquidating in nature. So, this means that the principal amount and interest are normally paid out of the revenue generated from the projects for which the loans were used. A debt is called unproductive if the loan is financed for war and other relief operations in case of emergencies. So, unproductive public loans are a net burden on the community. The government will have to resort to additional taxation to their servicing and payment. And the third one is the compulsory and voluntary debt. So, when the government borrows from the people by using coercive methods, loans so raised are referred to as compulsory public debt. When the government floats loans by issuing securities, the members of the public and institutions like commercial banks may subscribe to them. So, voluntary debt refers to the debt that are lent to the state by its own will and desire. Then, the obligatory debts refer to the debts which are lent by forcing to take the bonds issued by the government. So, these debts are applied in times of wars, natural disaster, or economic crisis. In itself, it is classified as the debts taken by the full compulsion, the debts taken by the threat of forcing. So, the debts taken by creating the necessary savings, and liabilities taken by the moral coercion. And the next one is redeemable and irredeemable debts. So the loans which the government promised to pay off at some future date are called redeemable debt. So loans for which and all the government does to agree to pay interest regularly for the bonds issued are called irredeemable debts. So redeemable debt is a debt which is repayable back to the lender by the borrower within the specific period, while the irredeemable debt is a perpetual debt. The borrower need not to repay it back to the lender. However, the interest payments are regular on irredeemable debt. So the redeemable debt has a fixed maturity date. All in all, that the advantage of public debts are as follows. The increase in origin in money. The public debts encourage industries in country, then the production increases, then the national income increases, by which the life standard of the citizens of the country increases also. So, and there is also a disadvantage, which is a lower national savings and income, higher interest payments, then leading to large tax hikes and spending cuts. So the decreased ability to respond to problems and the greater risk of fiscal crisis. And the second one is the public expenditure. So it is the spending made by the government of a country on the collective needs and wants such as pension provisions, which includes the education, the healthcare and housing, security, infrastructure, and others. So there are expenses that intended to the development of the state. The public or the government expenditures are generally classified into two categories. So the capital expenditures are the expenses whose usefulness lasts for more than 1 year and which add to the assets of the government. So including investments in the capital of the government-owned or controlled corporations and their subsidiaries. So the capital expenditure is the money spent by the government on the development of the machinery, the equipment, the building, health facilities, the education, and others. So it also includes the expenditure incurred on acquiring fixed assets like land and investment by the government that gives profits or dividend in the future. So the current operating expenditures are the purchases of goods and services and the current consumptions, the benefit of which does not extend beyond the fiscal year. So the two components of the current expenditures are those for personal services and those for the maintenance and other operating expenses. So what are the examples of operating expenses? So the common operating expenses for a company include rent, payroll, travel, utilities, insurance, maintenance, and repairs, property, taxes, the office supplies, the depreciation, and advertising. So the public expenditures are also broadly grouped according to their functions into the economic development expenditures, such as expenditures on agriculture and natural resources, transportations, the communications, and other economic development efforts. So, and the second one is the social services or social development expenditures. So, the government outlays on the education, the public health and Medicare, the labor and welfare, and others. And the third one is the general government or the general public services expenditures, such as legislative services, the administration of justice, and for pensions and gratuities. So the national defense expenditures are subdivided into national security expenditures and expenditures for the maintenance of peace and order. So these four are the dimensions of public budgeting has been planning for economic development through economic growth, employment, and social investment. That's all our report. Thank you.